Good afternoon, ladies and gentlemen. In today's presentation, I'll be sharing our key investment themes and outlook for 2023. It is time to move forward. That is the key message that we want to tell you for 2023. Before I start talking about next year's key investment themes, I would like to quickly recap how markets have done in 2022. As you can see, in 2022, most markets were in the red. And you can see that only a select handful of assets or markets managed to produce a positive return, namely Singapore, Indonesia, Thailand, India, Brazil, energy sector, and also Malaysia bonds. So only a select handful of assets managed to produce positive returns. Most were in the red. So there was almost nowhere to hide essentially. But it's time to move forward. In 2023 so far, we have seen that a swift rebound or recovery in a lot of the assets that saw big retracements last year. As you can see over here, a lot of greens. And we strongly believe that in 2023 will be a better year for investments, which I'll explain why a bit more later on. Before I talk about the 2023 key investment themes and calls, I would like to take some time to recap some of the 2022 calls that we made last year. So if you have been a long-term FSMOne follower, you will know that in the past, at the start of every year, we do give an update on how we did, what are the main calls that we are going to make for the following upcoming year. So similarly, in 2022, we did make some calls. In fact, we made 18 calls that you can see in the list over here. And unfortunately, we didn't get all correct, but we did get most of them correct. And essentially, by getting most of them correct, if you had followed our calls, you would have done slightly or relatively better compared to the benchmark. So just for an example, out of these 18 calls that we made, there were about 12 that we got correct, which is a 67% accuracy rate. Essentially, everything, as you can see, most asset classes were down last year. So by being less down, by dropping less, effectively you're actually better than the benchmark already. You're doing a bit better. So some of the calls we made, maybe they produce negative returns, but if that negative returns was better than something else, then I would say it's a win already. So for example, number one, for 2022, we called for equities to outperform fixed income, and we advised investors to overweight equities compared to bonds in 2022. So as you can see here, the MSCI World was down 11% compared to global bond index, which was down 16.8%. So effectively, if your portfolio was over equity over bonds, you would have done a bit better compared to the benchmark. Similarly, within developed market equities, so we always talk about developed markets. You have your US, Europe, and Japan. And essentially, we call for investors to underweight US and overweight Europe and Japan at the start of 2022. And that turned out to be a correct call because as you can see here, the S&P 500 was down more than 9%, whereas Europe and Japan were not as badly hit during last year's sell-down. So effectively, by overweighting Europe and Japan, your portfolio overall in terms of developed markets would have done relatively better. So these are some of the calls that we made for 2022. Now, you must be wondering what are our 2023 calls. So firstly, a global recession will likely be unavoidable. Okay, this is a key investment theme number one. So we're heading into a recession, but one thing to note is that we don't think this will be a very long drag and very bad recession like what we saw in 2020, during the COVID pandemic. You see here, global GDP negative 3%. So we think that a recession is coming, but it will be a mild one. Okay, probably 1 or 2 quarters of a small, slight recession. It won't be as bad as 2020. Okay, and particularly, one thing definitely is happening is that global growth is slowing down. Okay, you can see the growth numbers are trading downwards in 2023. We're expected to see slower growth overall globally. So what is the repercussion for investors is that investors should be prepared for earnings downgrades and also potentially margin compressions, because in a slower growth environment, right? So the economy is slower, businesses have less business, their business slow, their revenue generated will be slower, and the profits generated might be slower as well. So it's effectively, you could be in for some earnings downgrades going forward, and investors should be prepared for that, which I'll explain more later on. What are the steps that you can take to prepare for this potential recession that is coming in? Key investment theme number 2, with the slower growth environment, we are also facing inflation, high inflation and higher interest rates, and we expect this to stay relatively higher for longer compared to before. One thing to note is that inflation has already peaked in our opinion. As you can see here, inflation probably already peaked, but it's coming down, okay, moderating a bit, but it's unlikely to go back to the low inflation era that we saw pre-pandemic. Okay, the decade pre the COVID pandemic, we enjoyed a period of very low inflation and low interest rates. So in our opinion, inflation is here to stay. It will stay relatively high, and there are key drivers for that, which I'll explain a bit more later on. And the repercussion of that is central banks are likely to keep interest rate at a higher rate compared to pre-pandemic levels. Okay, so investors, how you could brace yourself for this kind of period, I'll give you a bit of advice later on as well. So these 2 key themes will drive the investment environment for 2023, which is slower growth, okay, recession, but a mild recession, higher inflation and interest rates as well, which will stay higher for longer. So what is the repercussion for that? Effectively, when interest rate will push up in 2022, right? You saw all the central banks around the world aggressively hiking interest rates. So what was the impact of this? So effectively, it helped to push bond yields higher. So bond yields are now above pre-pandemic levels because of the aggressive interest rate hikes. And because of that, we actually like bonds compared to equities, okay, relative to equities for 2023. So in terms of asset class, for 2023, we like bonds. So key investment theme number 3, we advise investors to overweight fixed income relative to equities. So what does overweight fixed income mean? It doesn't mean that put all your money into fixed income. Okay, it essentially means that if, let's say, for example, your neutral portfolio, we ask you to put a bit more into fixed income. Let's say you are a balanced investor with normally 50% equities, 50% bonds in your portfolio. We advise you to take a bit more from the equity, put into your bonds. For example, like 55% bonds, 45% equity, or 60% bonds, 40% equity. Okay, so why we are asking you to overweight fixed income or relative to equities? So essentially, what I mentioned just now, the aggressive central bank hikes have pushed bond yields to levels not seen in many years. Okay, and relative to equities, bonds look more attractive. So I have this chart here, which is called the global bond equity earnings yield ratio, BEER in short. So it's effectively, this blue line is this ratio, and you can see for many years post the global financial crisis, right? Because of the low central bank interest rates, right? Bond yields have been very low for very long. Okay, until last year, this blue line went above this orange line. So normally this tends to indicate that the relative attractiveness of bonds as an asset class versus global equities, okay? Global bonds versus global equities. And this is the first time that this blue line is above this orange line in more than a decade. And this blue line is at the highest level since the global financial crisis. So this tends to suggest that bonds are relatively more attractive compared to equities, okay? Because bond yields are so attractive right now, dividend yields are less attractive. So we actually advise investors, or earnings yields are less attractive. We advise investors to always put a bit more in fixed income this year. putting more money into bonds is also a more defensive positioning, especially in an uncertain or slower macroeconomy environment. So by doing that, you can effectively cushion against some of the potential risks of earnings downgrades or stock market volatility as well, because bonds are relatively more stable in your portfolio. Okay, other than looking at the returns, the risk part is also, it will help weather your portfolio better during this kind of market uncertainty. Now I move on to number 4. We like bonds, right? So within bonds, we prefer investment grade over high yield. Okay, so when we talk about bonds, you have your investment grade bonds, which are BBB rated bonds and above. So triple B, that you see here, single A, double A, triple A. So these are investment grade. Then anything below triple B, like a double B, single B, all these are what we call high yield or non-investment grade. So why do we prefer investment grade over non-investment grade in 2023? Because we think that the slower growth environment, the uncertain macroeconomy, investment grade bonds, which are the companies that are stronger, they have stronger balance sheet, they can withstand this environment better compared to weaker companies, right? Because they have the balance sheet, they have the assets, they have the cash. In case of any uncertainty, they can withstand better compared to non-investment grade bonds or non-investment grade companies. So the default risk for investment grade is still lower compared to the non-investment grade or the junk bonds. Okay, and within the maturity, with the long duration, short duration, or medium duration bonds, we prefer short duration investment grade bonds. So why is that? Because if you look at this line, right, effectively the yield curve is quite flat. So that means, what does that mean? That means the extra yield that you take for investing in a longer maturity bond is not that much more. Okay, you only get a bit more for investing in a longer term bond. But if you invest in a longer term bond, you're taking on higher interest rate risk. The bond price will be more volatile. So what we think is the shorter end of the yield curve seems, in terms of risk reward, more attractive for investors. You get similar yields, but much lesser risk. So that's where we advise investors to go into for 2023. Next, within Malaysia bonds, so I mentioned that, okay, global bonds look attractive because all the central banks around the world have been pushing the interest rate higher, which boosted bond yields to yields that never seen before since the global financial crisis. Similar thing also happened in Malaysia. So if you follow, our BNM, Bank Negara, has also hiked the interest rate, and this pushed our Malaysia bond yields to pre-pandemic levels. So effectively, what if you invest in Malaysia bonds now, you're getting yields that were some of the highest yields that you could have seen in the past few years. Okay, so this is a MGS 5-year yield chart. So effectively, we are getting similar yields compared to pre-pandemic levels, and the spread between the yields that you get from bonds compared to your OPR or your risk-free rate or your fixed deposit rate, the spread is still relatively wide. Okay, so in our opinion, Malaysia bonds is also quite attractive, and as what we saw in 2022, right? Malaysia bond was one of the most resilient segments. Let's see, go back to this chart. So Malaysia bonds were one of the most resilient bond segments in 2022, and we think that, yeah, global bonds, the bond yields, because they are so attractive right now, you should put your money there. Malaysia bonds, you shouldn't forget or ignore as well, because they play a crucial part in terms of stabilizing your portfolio, as what we saw in 2022. Okay, so Malaysia bonds are key to help your portfolio ride out the market volatility. Now I've talked about fixed income, I talked about bonds. What about equities? What other regions do we like within equities? So key investment theme number 6, we prefer developed markets over emerging markets for 2023. So because we think that the relative risk reward seems to be better for the developed markets in 2023, with the higher risk premium that we have put on China. Okay, effectively, investors would need a higher upside potential from China in order to make it worthwhile to invest in like China-related assets or Asia, that's quite heavily weighted into China. So we think for 2023, a safer bet or better risk reward kind of investment will be developed markets, the US and Japan in particular. So for in terms of monetary policy, it's also we think that interest rates are sort of peaking already for the US, and if let's say things start to change a bit, we could see the US start to pivot and put an interest rate pause or even cut rates going forward, and this will be beneficial for the market. For Japan, they continue to be quite accommodative, and this bodes well for the equity market over there as well. And with the retracement, the big retracement that we saw last year for all these markets like US and Japan, the valuations are also much more attractive compared to before. So you look at some of the big companies, the big MNCs or the tech companies, for example, they're trading at very attractive valuations that you couldn't have gotten in the past decade or so. So it's a good opportunity to try to pick up some of these good companies, quality companies right now in the US and Japan. And we think the risk reward is also more attractive because the relative stability that these markets tend to provide compared to the more volatile China or Asia related markets. Europe is the least attractive in our opinion. They still have some uncertainties because of the Russia-Ukraine crisis that's happening over there. That's still ongoing, in fact, and this actually has a lot of repercussion to the European economy. In fact, they are most likely to go into a recession in 1 or 2 quarters down the road, and this will ultimately affect the businesses and the corporate earnings over there as well. So within developed markets, we like developed markets relative to emerging markets. We advise investors to overweight developed markets, especially US and Japan. So if your portfolio is very emerging market or Asia oriented, it's a good time to add some developed market exposure. Next, outside of developed markets and Asia and EM, don't forget ASEAN as well. So ASEAN is one of the markets that would benefit from this shift away from China. So as you can see, if I go all the way back, right, ASEAN markets were some of the better performing markets in 2022. And this shows the importance, like Singapore, Malaysia, Indonesia, Thailand. So these markets have done relatively better compared to the rest of the world. So this proves or this shows the relative low correlation, the relatively low correlation that ASEAN markets have compared to the rest of the world. And because of this low correlation, it does help in terms of portfolio diversification, because whatever happens in US or Asia, it doesn't affect ASEAN as much. So ASEAN is also one of the beneficiaries of the shift away from China. So with the COVID pandemic, during the COVID pandemic, a lot of multinational companies that rely heavily on China for their supply chain would realize that, okay, the importance of diversifying their supply chain outside of China, because of the COVID lockdown, the zero COVID lockdowns in China, a lot of these MNCs couldn't get their parts or their products out of China. It was stuck in the port. They couldn't produce because all the factories were under lockdown. So effectively, their businesses were affected. So because of that, they realized the importance of having a diversified supply chain. And ASEAN is the next closest thing that they can look at. So places like Vietnam, a lot of MNCs are setting up manufacturing plants over there, and Malaysia as well. So recently I went to Penang, and I saw a lot of MNCs building up semiconductor factories around the Penang area, like near the second bridge area. So these are some of the examples of how all these MNCs are diversifying their manufacturing outside of China so that they become resilient in case there are future like COVID type of pandemic lockdowns and so on, so that they could hedge away some of this China resilience. Another example that I also saw would be if you have read the news, Samsung also they are investing 6 billion ringgit to build an EV battery factory in Seremban. So these are some of the examples of big MNCs investing heavily outside of China to boost up their manufacturing plants outside of China. So with that, ASEAN will definitely be one of the beneficiaries because all these FDIs coming in, it will boost the job market here, it will boost the corporate earnings over here. And yeah, valuations are still relatively cheap, relatively affordable, currently trading at around 12.2 times PE only, which is a few multiples below our fair PE of 16 times for ASEAN. So if your portfolio, you look at your portfolio, you have a lot of developed markets, US, Japan, you have a lot of Asia, a lot of China. ASEAN could be a market that you're missing out on. Okay, if you had some ASEAN exposure last year in 2022 in your portfolio would be more resilient. Okay, and at the same time, right, a lot of Asian funds, because ASEAN, the market cap of ASEAN markets are relatively small, so a lot of Asian funds have very little exposure to ASEAN. So this is a market that you need to manually or you need to personally add into your portfolio yourself in order to get exposure to this market. Okay. Within ASEAN, we like Singapore and Malaysia, especially Malaysia. So if you have been a long time FSMOne follower, you will know that we have been neutral in Malaysia for quite a number of years. Okay, but we think this time has changed. So especially after the elections that we had at the end of last year. So you see, you notice that after the election results came out, right, we had a hung parliament, but when the new government was confirmed, right, there was an immediate shift in investor sentiment. You saw the equity market jump, you saw bond market jump as well, and you saw the ringgit jump as well. Okay, so there's an evident shift in investor sentiment towards the expectations of this new government that is expected to be cleaner, more transparent, more competent, and also business friendly. This will also put aside many years of political uncertainty because of the pact that they have. Investors are expecting the government to at least stay longer compared to previous governments that had very short stints. So the investors' sentiment has definitely changed after that. And because of the political uncertainty that we had for many years, investors had been ignoring Malaysia to a certain extent, and because of that, valuations were relatively cheap. Okay, currently they're still trading at relatively cheap valuations, 12.2 times PE, which is a few multiples below our fair PE of the market of 16 times as well. So Malaysia is also a good market for stock picking. If you notice, right, a lot of Malaysia fund managers, they do very well in terms of outperforming the benchmark like KLCI. So it's a good place to generate alpha, okay, for fund managers. So it's definitely investors who have no or little exposure to Malaysia should definitely reconsider this underappreciated market. Next, I'll talk about India. So other than ASEAN being a beneficiary of the shift away from China, India is also another beneficiary. Okay, they have similar kind of traits that China had 20 years ago, okay, when China was reopening. They have a huge population, that one is without a doubt. They have a rising middle class, from low to middle class population, similar to what China had. Manufacturing, manufacturing hub as well. The population is also very young. Young population means there are a lot of people working and generating, boosting the economy over there, and also economic policy reforms that's expected to shift India going forward. So this India has the similar traits that China had 20 years ago. So it's still at early times, and India could be the next China. If you have read news also, India's population is expected to overtake China by 2035, something like that. So that being said, right, yeah, we like India, but currently valuations are not cheap for India. Okay, currently trading at 17 times, which is more or less around the fair PE that we have for the market. So what we're trying to highlight here is that, yeah, the next decade belongs to India. You should add it into your watch list. Maybe not now, but if let's say there's an opportunity, there's a retracement in the market that's away from fundamental, that's not aligned with fundamentals, then it's a good opportunity to add some exposure here. Because similarly, if let's say you have an Asia or EM portfolio, the India exposure is is there, but it's not that big as well. So if you wanted more exposure to India, you have to manually add them yourself. Next, I've talked about the regions that we like. Now I'm going to talk about the sectors that we like. So key investment theme number 10, we like value stocks. Okay, we think value stocks will outperform growth. So typically when we say when we want to categorize stocks, right, they are typically value or growth stocks. What are growth stocks? So everyone knows that. So growth stocks are companies or stocks that can grow their revenue at very exponential pace, okay, and exponential earnings as well. So these growth stocks tend to trade at higher valuations because people are buying into their future growth. Okay, then value stocks typically are, yeah, they're still profitable companies, but they don't grow as much as growth stocks. Okay, they grow maybe single digit, at most high single digits in terms of revenue, in terms of earnings, but they tend to be more stable as well. They're the profitable cash flow generating companies that pay good dividends. It's just they don't grow as much as growth stocks. And because they don't grow as much as growth stocks, the markets tend to put a lower PE or lower valuation to value stocks. Okay. And for many years, if you look at this chart over here, growth has outperformed value. Okay, so this line is basically the outperformance of value compared to growth. So if it's moving upwards, that means value outperform growth. If it's moving downwards, trending downwards, that means growth outperform value. So for many years since 1985, growth has been the long-term outperformer. Okay, as you can see here, but there are certain periods where value does outperform growth, as you can see here, and it tends to coincide with periods of rising interest rates, such as in the late 80s, 1994, 95, 2000, 2005 and onwards, and the most recent post QE, 2016 onwards. So during these periods, growth value tends to outperform growth, and we think that going forward, because of high interest rate environment, value should continue to outperform growth. That said, right, we it doesn't mean that put everything into value. There's still good opportunities in growth. So there's still good growth companies out there that we definitely depend on the fund manager to go and look out for. So what I'm trying to say here is that in the past, if let's say you have been very growth oriented, probably very tech oriented, you probably would have suffered in 2022. Yeah, okay, but if you are still very growth oriented in your portfolio, you should consider reduce some of this growth reliance and then put some value oriented positioning in your portfolio just to balance it out. So a lot of fund managers, they have this strategy that they call barbell strategy. They'll have value and growth in their portfolios so that they can sort of balance out this kind of risk during different market environments. Similarly, if your portfolio is very growth oriented, you just look at the funds that you have. If your funds have a lot of growth in the names, right? Growth fund, growth fund, growth fund. Essentially, that means your portfolio is quite growth oriented. So what are value tilted kind of funds will be like funds that have dividends or value or income in the fund name. So that's probably one of the ways you can identify whether the fund is very growth or very value oriented. Next, commodity linked equities. So we think that commodity prices will stay relatively high going forward, mainly because of the supply and demand gap, the mismatch over there. So if you're aware, post pandemic, right, there was a sudden huge demand for all these commodities. Okay, commodity prices flew. Okay, you have your oil price, your copper, iron, aluminum, and etc. All this flew, and at the same time, right, demand spiked, but supply was tight because during the pandemic, right, a lot of all these miners, they cut their investments, they cut their capex, so they mine less of all these materials because of the pandemic, right? So there was a lot of uncertainty, so they reduced their investment there. Because of that, the supply was lesser, but demand shot up. So this caused the supply demand mismatch that we saw. and prices to go up. So commodity prices, we think going forward, can still stay relatively high because there's still a big gap to cover. Okay, after the supply mismatch that we had post-pandemic, there's still a big gap to cover. So this chart essentially tries to illustrate how big the gap is for the supply and demand. So you can see here, right, for each of the commodity like aluminum, copper, lead, and etc., these columns are essentially their supplies, and they have been going down. Okay, supplies have been going down. Okay, and supplies have gone down much lower than compared to the pre-pandemic average of 2010 to 2019 period. This line over here. So there's a big gap over here to essentially cover if you want the supply to go back to the previous 10-year average, right? There's a big gap to cover. So miners will need to dig more and so on. You need demand to come down a lot. So, but we think that demand will still be strong, especially in um, some of these metals that are important for your renewable energy kind of related sectors, because they do take up a lot of all these commodities, and this is a sector that is still booming. I'll probably explain more later. And because of this supply demand mismatch, we still think that commodity prices will still stay relatively high going forward. And who will benefit is actually companies that sell all these commodities, right? And also those countries that are commodity rich will benefit. So the oil prices, if oil prices continue to stay high, who will benefit? Essentially countries like Malaysia, some Middle East countries, and so on, all these oil producers. This is just one example of how a country or a company can benefit from high commodity prices. And so if your portfolio, right, you can consider adding some of the commodity-linked equities into your portfolio. It also acts as a hedge against inflation, because commodities tend to be quite inflationary in nature. Okay, and this one would help essentially hedge against any inflation staying relatively high going forward. And yeah, next, so I mentioned the key investment theme number one is that we expect recession to come. And with recession, there are certain sectors that tend to be more defensive, tend to be less volatile. And it makes sense because, like, for example, like healthcare, consumer staples, infrastructure. So for healthcare, recession or not, people still need to go see the doctor, people still need to take their medicine. Consumer staples, similarly, during recession, people still need to eat their rice, still need to eat their wheat, and so on. So these sectors tend to be more resilient in terms of their revenue and earnings during market cycles, right? Infrastructure, similarly, like you still need to, you still need your electricity, you still need your water, and etc. So defensive sectors is a good way to to buffer your portfolio during kind of recessionary environment. And one of the sectors that we like is healthcare sector. So it's still relatively cheap. Okay, so trading at around 15 times PE, and mainly because of the resiliency of healthcare, it does help buffer your portfolio going forward. Other than the upside potential, of course, consumer staples as well. Number 13. So just now I touched a bit about renewable energy. So what I'm trying to say in theme number 13 is that sustainable investing is a thing. Okay, it's definitely happening, and it's going to gain pace going forward. So especially with the recent events that we saw, like all these extreme events, extreme weather events, such as in Malaysia as well, you see the flood is getting worse. In the US, you see snowstorms, like very bad snowstorms in the US. In Australia, you can see the super hot weather. So where the climate change thing is real, and a lot of governments are realizing that is real as well, and they are putting targets in order to some commitments in order to work towards better kind of carbon neutrality or net zero targets. And this chart sort of illustrates that. as you can see here, certain markets or certain countries like Japan, Australia, Vietnam, they have set 2015 as a target year to hit net zero carbon emission. Malaysia, South Korea, 2050 as well, carbon neutrality. So what does this mean? That means if governments they are committing to going net zero or carbon neutrality, that means they need to invest. They need to put money to achieve these targets, right? So if they're putting money in, so let's say they're building more solar farms, they're building more renewable energy, they are building more, let's say EV related, or they're giving out policies, implementing policies to boost electric vehicle. So this kind of things. So essentially, they are moving towards this direction. And as an investor, if you want to catch this trend or take advantage of this, one of the ways you can do is to invest in those sustainable investing kind of stocks or sustainable investments. And in Malaysia, we do have some of these. We don't have many, okay, sustainable investing related funds, but we do have some that are quite good, mostly global funds. So this is one way that you can sort of ride the trend of um, sustainable investing. Okay, so if you don't have any sustainable related investment, yeah, you can consider to add them. Okay, now I move on to currencies. Some of you may ask what are the currencies that we like, what are the currency calls that we made. So last year we actually liked the US dollar, and we also were negative on the Japanese yen. So if let's say we advise investors to go into Japan, it will be in a Japanese yen hedge fund. So for this year is the other way around already. So we think that the US dollar has peaked. Okay, much of the positiveness that drove the US dollar last year has already happened. So what mainly drove the US dollar appreciation was the interest rate differential that we saw. Okay, so the US Fed were hiking interest rate much more aggressively compared to the rest of the world. The rest of the world were hiking, but not as aggressive as the US. And because of this widening interest rate differential, it boosted the US dollar. But in 2023, all the other central banks, as the US starts to slow down in terms of their rate hikes, the rest of the world, the other central banks are catching up. So the differential will narrow, and this will cause we think, the US dollar to weaken. And this has actually happened already. If you notice, US dollar against ringgit, the highest was what, 4.75 at the end of last year. So look at where the dollar ringgit is right now. So there's probably a bit more room to go up for the dollar to come down going forward. So what's the repercussion for this is that for investors who invest in US dollar related assets, we advise you to go into hedge classes. So if let's say you invest in US equity fund, yeah, so you go into the hedge classes of those, or you invest in US dollar bond fund or global bond fund, go to the hedge classes, okay? Or even Hong Kong dollar also, because Hong Kong dollar is pegged to the US. If you invest in a Hong Kong equity fund or Hong Kong bond fund, similarly go into their hedge classes to hedge away the risk of US dollar weakening. Here, okay, that's the 14 key investment themes and calls that we are making for 2023. Here is the list of them. So I'll just recap them very quickly. Number one, a global recession will likely be unavoidable, but we think it's a mild recession. Number two, inflation and rates are expected to stay higher for longer. In terms of asset class, we advise investors to overweight fixed income relative to equities, and within fixed income, we prefer investment grade over high yield. Even though global bonds, the relative attractiveness has gone up, gone up a lot. But don't forget Malaysia bonds, especially for Malaysian investors, where most of our assets will be in ringgit terms. Malaysia bonds is a good portfolio buffer. Within equities, we prefer developed markets over EM. Outside of developed market and EM, ASEAN is a market that we like. We think that ASEAN will benefit from the shift away from China, and it's sort of you can say hedge away from some of the political uncertainty that's happening, like for example, the US-China trade war and also the Russia-Ukraine war, ASEAN is a region that is relatively shielded from all these geopolitical risks. Okay, and within ASEAN, we like Singapore, especially Malaysia. Okay, we think that investor sentiment has changed in Malaysia, as you can see with the equity, bond, and ringgit markets that happened after the election. Malaysia is also a good place for active management, active stock selection, as we can see, as we have seen in the past, how our local fund managers have consistently beaten the KLCI benchmark. Number 9, India would also benefit from the shift away from China. We think that the next decade should belong to India. Do add it to your watch list. Current valuations are not cheap, but if there's an opportunity, you can add India into your portfolio. Number 10, we think value stocks will continue to outperform growth. Number 11, commodity-linked equities will benefit from the supply tightness. Number 12, defensive sectors are good for portfolio resiliency, especially during recessions, because these businesses or these companies tend to be more stable, their revenue tend to be more sticky even during recessions. Number 13, sustainable investing is here and is now more important than ever. If you want to catch this trend, we have funds that can give you exposure to sustainable investing. And number 14, in terms of currencies, we think the US dollar has peaked. If you want to go into US related or US dollar related assets, consider the hedge classes to hedge away the US dollar weakness. Okay, that is all from me. Now I'll take some questions from the ground. So, okay, can you suggest any unit trusts related to ASEAN? So here I have a few. Principal ASEAN Dynamic Fund. We have 2 recommended funds for ASEAN. Principal ASEAN Dynamic Fund. Do look at this. It has a strong track record over the years of outperforming the ASEAN index. Then this is for conventional investors. If you are looking for Islamic options, there's the Saturna ASEAN Equity Fund. So this fund is quite resilient. They invest in long-term good quality growth, good quality companies. And if you can look at the track record, they have been quite resilient over the years despite the market volatility. Okay, so next one, is ASEAN more attractive? I see a lot of questions for ASEAN here. Is ASEAN more attractive than the US or Japan? Okay, so for ASEAN, our star rating for ASEAN is actually 3 stars. Within ASEAN, the 4 major markets, we like Singapore and Malaysia. Okay, they are both 3 and 3.5 stars, 3.5 stars respectively. But we are neutral on Thailand and Indonesia at the moment because these 2 markets were one of the better performers last year, and we think that the valuations have caught up to the fundamentals. So at the moment, the upside potential is not as much as Malaysia or Singapore. Therefore, for Thailand and Indonesia, we rate them neutral at the moment. So overall ASEAN, we rate 3 stars. For US and Japan, Japan is our top equity market pick for 2023. Is rated 4 stars. So I would say that all ASEAN, US, Japan, they're all attractive, but seems like Japan is the most attractive among the regions that we cover. So please recommend a few bonds available for investors. I think this one I'll leave it to the bond dealing team. You can talk to the CIS about the individual bonds. Okay, next, what's the outlook for China or China A shares or Hong Kong? So, in our opinion, if you have been following us, we have been positive on China for quite a number of years. Okay, but unfortunately, because of the last year's election in China, the re-election of Xi Jinping, we think that the risk of the country risk or the country risk premium has increased. So effectively, because of the narrative, a lot of the narratives that he preached, okay, for example, like zero COVID, and then like some of the military drills that they were doing in around Taiwan, this kind of thing, and also the geopolitical risk with the US because of the trade war, the tech trade war, and also some of the risks that increased because of the attack on some of the industries. Okay, so for example, like they suddenly declared that private education was gonna be non-profit. So effectively overnight the industry became uh, wiped out. Okay, so China tends to, because of that, we think that the country risk has increased for China, and we think that in order to invest in China, you would require a bit more potential return. Okay, in order to invest in China, because of the rally that happened recently, okay, there was a strong rebound in China and etc. So we think that upside potential has decreased already. So we think that at the moment China is less attractive compared to the developed markets of US and like the US and Japan, which provide better risk reward lah. So China, there's still some upside, but it's lesser now because of the recovery that we had, and because of the risk premium that we put on China due to the higher political and geopolitical risk that's going on. Uh, we we actually downgraded China to neutral. Okay, so effectively, if you have a lot of China in your portfolio, perhaps it's time to take some profit or reduce the exposure, move some into developed markets which provide better risk reward, because over there is still more stable in terms of, especially in terms of policy. You don't see suddenly the government coming in and then wiping out an entire industry like the private education sector, or suddenly attacking some of the big tech companies just because yeah, they're too monopolistic and so on. Maybe they'll put fines and so on, but they won't like hamper the whole industry. And so I think hopefully that answers the question. Why no Vietnam fund? How is the investment in Vietnam? Okay, in Malaysia, we don't really have that many Vietnam funds. Vietnam is definitely a high growth market. Okay, it's an emerging economy. We do have Vietnam ETFs if you're looking for exposure to Vietnam, and the ETF, the track record of the ETF have been quite strong because over the years Vietnam has grown tremendously. Their GDP, their economic growth has been one of the highest around the world, especially, and there's a lot of investment FDI into Vietnam, especially with the growing shift of manufacturing outside of China. Vietnam is definitely one of the beneficiaries. So there's no actively managed Vietnam fund on our platform, but you can get exposure through some exposure through the ASEAN funds. Principal ASEAN Dynamic Fund has some exposure to Vietnam, or if you want just purely Vietnam, you have to go for ETF. So there's a Vietnam. There are a couple of Vietnam ETFs out there. So do check them out. Okay, so hopefully in the future we'll have some fund houses launching Vietnam funds, then we can invest in actively managed Vietnam funds. I believe that's all the questions I have. Thank you very much. If you have any more questions, you can always talk to our CIS. Okay, hopefully that was a useful session for you guys. Thank you very much. Bye bye.